Right now, the financial world is screaming at you. Headlines are telling you to buy gold, hoard cash, or that the AI bubble is about to burst and wipe everyone out. It is noisy, it is confusing, and quite frankly, it's terrifying. But here's the truth they don't put in the headlines. While everyone else is panicking, a quiet group of people are getting richer. They aren't day trading and they aren't glued to the news. In this video, I'm going to cut through the jargon I spent years learning. I'm going to show you exactly which headlines are right, which are wrong, and give you a tried and tested strategy to not only protect your money, but ensure you come out ahead in 2026 and beyond. Let's get back to basics. What is investing, really? At its core, it is simply using your money to make more money. But why is this non-negotiable? Why can't you just save your salary and be safe? Two reasons. The first is a silent thief called inflation. Imagine you have $1,000 sitting in your bank account today. It feels safe, the number doesn't change, but the value of that money does. In a few years, that same $1,000 might only buy you $800 worth of goods. Prices rise, but the cash in your savings account generally doesn't keep up. Doing nothing feels safe, but it is actually the slowest, most guaranteed way to lose your wealth. The second reason is a bit more controversial, but it's the reality of the economy we live in. We are living in a world where owning assets like property, stocks, or businesses is rewarded far more than simply earning a salary. Think about it. Salaries have barely kept up with inflation, but someone who bought a house 20 years ago has likely seen its value double. Someone who invested correctly in the stock market has seen their money grow by an average of 8 to 10% a year. If you're stuck in the cycle of earning and spending, you're constantly falling behind. To break that cycle, you need to be investing. So, how does the stock market actually work? It's a term everyone knows, but very few actually understand. When you buy a share, you aren't just buying a digital number on a screen. You are buying a literal piece of a company. If you buy one share of Netflix, you own a tiny fraction of Netflix. You are betting that the company will continue to make great products and become more valuable over time. The stock market is just the marketplace where people trade these tiny pieces of companies, with prices fluctuating based on what people think those companies are worth at that moment. Now, how do you actually get paid? There are two ways. First, capital gains. This is simple. You buy low and sell high. If you buy Netflix at 100 and sell it years later at 150, that profit is yours. The second way is my favorite, dividends. Some companies share their profits directly with you just for holding the stock. They might pay you every 3 months or annually. It is essentially the company saying, "Thank you for being a shareholder." It is truly passive income. Now, here is where most beginners lose their money. You might be thinking, okay, I get it, I'll just buy stock in the biggest companies, like Netflix. You could do that, but it is incredibly risky. Even the giants fall. Do you remember Blackberry? In 2008, we all thought Blackberry was the future. If you bought one share back then at its peak, it cost $144. Today, that share is worth about $4.52. Back then, nobody predicted we would ditch BBM for WhatsApp or iMessage. But technology shifts, trends die, and unless you want to spend your evenings analyzing balance sheets, which almost nobody wants to do, it is nearly impossible to predict which company will survive the next 20 years. This is why successful investors don't try to guess the winner. They buy all the winners. They use index funds. An index fund is a basket of hundreds or thousands of companies. For example, the S&P 500 tracks the 500 largest companies in the US: Apple, Microsoft, Google, Tesla, and hundreds more. Here is the power of the index fund. If you invested $100 in the S&P 500 at the start of 1996 and reinvested your dividends, today you would have about $1,764. That's a total return of over 1,600%, or roughly 10% per year. Even accounting for inflation, that's a solid 7.5% annual growth. By investing in the whole basket, you lower your risk. If Netflix crashes but Apple soars, you are still protected by the general upward trend of the market. I know what you're thinking. Why buy the whole basket? Why not just buy the Magnificent Seven? Apple, Microsoft, Amazon, Nvidia, etc. They're dominating right now. It's a valid question. Why dilute your gains with smaller companies? Here is the history lesson that might save your portfolio. If you looked at the S&P 500 back in the 80s, the top companies were completely different. General Electric, ExxonMobil, Walmart. The winners change constantly. Go back even further to the 1960s and 70s. The Nifty 50, companies like Kodak, McDonald's, and Coca-Cola were seen as untouchable. Investors poured money into them assuming they would grow forever. Then the bubble burst in the mid-70s. Kodak stock eventually fell by more than 90%. There is absolutely no guarantee that today's winners like Nvidia or Tesla will be in the lead a decade from now. Plus, the US economy has its own uncertainties. It makes sense to own a little bit of everything, even companies from other parts of the world, to reduce your risk. So, we have the strategy. Now, how do you actually press the button? Here is your step-by-step guide. Step 1. Pick a platform. You need a reputable website or app to buy your funds. The most critical thing to check is fees. High fees will eat your returns alive over time, so ensure they are low and the platform is regulated. Step 2. Tax efficiency. Before you buy, look at the account type. In the UK, use a stocks and shares ISA. In Canada or Australia, look for a TFSA. In Japan, a NISA. These protect your profits from taxes. Pro tip, if your employer offers a workplace pension with matching contributions, do that first. That is literally free money from your boss. Take it. Step 3. Choose your fund. Don't overcomplicate this. Start with a global diversified index fund. It beats picking individual stocks almost every time. Step 4. Automation. This is the secret sauce. Set up a direct debit for a set amount, say $100 or $200 a month, and forget about it. This is called dollar cost averaging. Some months you buy high, some months you buy low, but it averages out. Most importantly, it removes the temptation to time the market or mess with your investments. Before I let you go, we have to answer the million-dollar question. What if it all goes wrong? What if the market crashes next year? If you are diversified in funds, you're already protected against individual company failures. But the biggest risk to your money isn't the market, it's you. You see a guy on the news screaming about a crash, you panic, and you sell. Best case, you miss out on future growth. Worst case, you lock in a loss and destroy your wealth. Automating your investing stops you from panic selling. It keeps you disciplined. If you've been waiting for a sign to start, this is it. Don't let another year go by just earning and spending. Make your money work for you. Thanks for watching, and I'll see you in the next one.